Welcome back, Guy. Another great meeting with today we have Martin Escobar. Hi, Martin, and thanks for coming.
Hi, Domenico. Thanks for the opportunity.
Martin asked me, it's a value investor. We are both certified by eToro in this case inside a project that is highlighted all the popular investors that have a strategy based on value investing. So everyone on us make full analysis on the company. We have already done another two meeting with other two popular investors analyzing MetLife and Vistra. If you want to see the full analysis of those two companies, you will find the playlist just in the link above. But today with Martin, we are going to discover another great company, another great analysis made from Martin. But Martin, for the one that doesn't know you, do you want to briefly introduce yourself?
Yes, for sure. Well, I live in Bolivia. I work in the central bank of my country in the investment team that manages the FX reserves. Previously to that, I worked in a pension fund, also in my country. In average, I manage in both companies closer to $7 billion. And as you said, we are that kind of investors that like to understand the history behind the numbers that we see in balance sheets and in different kind of financial reporting of companies. So yes, we are value investors, and this time I introduced this investment opportunity related to Cummins, a US company.
Perfect. Now we are going to see the full analysis made from Martin. But if you want to see our full portfolio, because our both portfolio are absolutely public, you will find the link down below in the description. So now it's time to start, and let's deep inside the analysis of Cummins. That is one of your last great picks in your portfolio.
Yes, that is true. I purchased stocks in the between February and March of last year when the market collapsed, and at that moment I purchased the company at a greatly discount relative to what I believe its intrinsic value. But even though we have now higher prices, I still see an opportunity on the company. And I mean, I believe that for your audience, it would be interesting how we understand the story, the narrative behind this company, and why it should be in the watch list of, I believe, any value investor. This is a brief description of the company. Cummins is the US leader in engine designs and engineering and manufacturing for predominantly high-duty trucks around the world. The company basically supplies parts and service to trucks manufacturers in over closer to 200 countries through a distribution network of 600 distributors and over 70,000 dealers. Now, the company sells more closer to the half of its products to the US because it's a US-based company, but also it has exposure to emerging economies like China, India, and the rest of the world. It's a company that generates closer to 20 billion in sales per year, net income closer to 2 billion per year, free cash flow also closer to the range of the $2 billion. Last year, the company finished the year with an EPS of $12 and a dividend per share of closer to $5.2. Right now, the company is trading at 20 times, and as you can see here in the bottom left of the slide, the stock price behaved closer to, resembles the performance of the stock market. It is important to mention that the company operates under 5 main segments. One of those segments, the first one, is the engine segment. You know that engines are the heart of every automotive truck, and so it's its core business. But also it has the segment of distribution, the channel that from which sales are channeled to customers. It also sells components more related to the aftermarket sales. Components provides service to customers, because usually customers use these engines for terms of 10, 15 years. So the company, after selling the product, is still providing services of maintenance and selling components, right? But the company also is entering into the business of power generation and new power. That is engines that generate electricity. So I will tell you more going forward. Now, the beauty of our approach that Domenico and I share is that we like to understand, as I said before, what is behind the numbers of the company. What is the company? Where industry it is playing for saying something, and how are the dynamics that surround the company. So it is important to understand the industry background. As I said before, this company sells engines, which are not necessarily final products, no. And what happened to engines? We know that what customers want from engines is that engines have to be the better cost fuel efficient. I mean, the highest performance at the lowest cost relative to how much fuel it consumes, the engine. Since 2000, the industry of engines was subject to a strong regulation for emission standards. In the US, we have the EPA regulations. In China, recently, they introduced the national standard 6 regulations, and those regulations are timing the amount that an engine can pollute the environment. What happened with this is that this creates high barriers to entry, because for playing in this industry, you need to comply with those strong regulations that require a lot of research and development to design this kind of engines. That helped the company. The company take this as an opportunity, obviously, because you can also see it as a challenge. The company took it as an opportunity, and they developed really advanced engines. So right now, according to trucking companies, the best EPA approved engines is those from Cummins, which is called the ISX. Now, what also happens in the industry? I try to understand the demand change in the industry, and we have 3 players. First comes the engine manufacturers, where are Cummins, companies like Caterpillar, those companies that are heavily concentrated in manufacturing and designing engines, nothing else. And these companies this part of the change is highly concentrated, so they have pricing power. And then comes the original equipment manufacturers, where we have companies like Navistar, Emlier, which basically are companies that only manufacture the chassis of a truck, of an automobile. And because they don't want, and it is not cost effective to invest in engines, they purchase from engine manufacturers. This segment is also a highly concentrated. And then comes the trucking companies. And for trucking companies, I mean those companies that purchase trucks to provide services like transportation and those kind of services. And this part of the industry is highly fragmented. So they don't have pricing power. So what happened with Cummins in this part of the industry analysis is that Cummins plays in the engine manufacturer segment, as also it plays in the original manufacturer segment, but as a dealer. No? That's why they have the distribution segment, because they don't only sell to original manufacturer equipment, but they also try to contact with final customers, with end customers that are trucking companies and those players. So that brings another income component to the company. The main competitors of the company are Daimler, Packard, Volvo, and Navistar. Why? Because those companies, as I said before, they perhaps do not invest heavily as engine manufacturers in engines, but they also have their manufacturing processes of engines, but they still are heavily dependent on engine manufacturers. Recently, Cummins and Daimler signed another long-term contract that provides a good business for Cummins. Going in more detail to the business quality of the company, because what we want to know is that before seeing the price, before valuing the company, we want to know if it is a good company. A good price not necessarily means that it is a good company. So we want to know if it is a good company. I believe that this company has a high business quality for the following reasons. It has a US market leadership. As you can see here, the company has almost to a 30% of market share in the heavy-duty trucks and 80% of market share in medium-duty trucks. The company is also gaining market share in China. And this is a huge, a really important point, because currently the company has a 15% in market share. But as I said, China is also introducing emissions standards to control the pollution on its land. And that forced to trucking companies to buy better quality engines. And what happened last year? As everybody knows, last year was bad for everyone, but not so bad for China. They started to recover almost immediately after March. And in China, the market growth at a rate of the 35%. But Cummins sales in China growth at a rate of 47%. What does it mean is that Cummins is gaining market share in China. Because why? Why? Because companies in China, trucking companies, are requiring more cost fuel efficient engines like those of Cummins. And Cummins has the leadership in the market. One of the important characteristics of Cummins is that it has customer captivity. Why? Because, as I said before, the company sells engines, right? Those engines are in use by 10, 15 years. What happened in that period is that usually those engines require maintenance, some replacement of components, and they own, so the people that are in charge of the maintenance of these engines are specialized in Cummins engines. So that creates a whole environment, and it creates like a passive income business model for Cummins, because it sells the products, but then it has almost 10 years for generating aftermarket sales for the company, and customers every time are more engaged with the product, because they only have confidence in Cummins engines, and that creates network effect. Now, one of the things, as I said before, that resulted from the strong regulation in emission standards is that Cummins invested heavily in research and development to design those high quality engines, and that also creates a high barriers to entry. But not only that, it also the company also invested in new business opportunities, and right now one of these is related to the new power segment. That is right now the segment is losing money because it's only investing. It also generated sales last year that grew at a 80% rate. But this segment is trying to produce engines that will work with hydrogen. And as we know, a new Biden administration, President Joe Biden administration, is trying to push to the United States to embrace more friendly environment sources of energy, like hydrogen. So it's also a good thing. Now I want to talk about the management and execution of the company. In the right side, we can see the historic performance of the company over the last 7 years. What are the main things that I would like to know about management? That is one thing. If they are creating value to shareholders, that is a really important thing. If they invest in long-term business opportunities, if they invest in the business also, and if they are investing in those segments that create more value for the company. As we can see here, Cummins is a company that generates a high return on capital, in average 17% per year over the last 7 years, and we know as value investors that is a good return for capital. The company generates a cash flow from operations each year, and that covers sufficiently investment expenditure and a return to common shareholders. And by return to common shareholders, I mean not only dividends, but also share buybacks. We can see here below the EBIT margin of all the segments that I mentioned before. And we can see that the most profitable segments are engine and components. As I said, new power is a segment that right now is losing money. It's not profitable, but the segment does not represent more than 5% of sales. So,
do we know more or less this new power will become profitable?
It depends heavily in the adoption of hydrogen over the long term, in the next 5 to 7 years. I took this segment as an optionality. As a call option, a business that could work, or perhaps is never going to be profitable. So in that case, at the moment of buying the company, I did not take this segment into account.
Okay.
Yes, because it can create a lot of value for the company or nothing at all. But the segments of engine, distribution, components, and power systems are consolidated segments in the market, are market leaders. So I care more about those segments. And as we can see here, I calculated the capex, the cumulative capex over the last 5 years that the management deployed to each segment. And as we can see here, management invested more of the capex in the engine segment and the component segment. So that gives me a good signal that management is investing heavily on those segments that creates value, that are profitable. As you can see here, in the new power, they only invested over the last 5 years closer to 2% of the whole budget of capex.
Okay.
About the character of the management, the company is run by Tom Linerberger, who is in the church for more than 10 years. He was in charge of the company in the financial crisis. So he's a guy with experience. And about the chief operation officer, Livingston, he's in charge of on that position for one year, closer to 2 years, but he's in the company more than 20 years. So he also has a lot of experience about how to run the company. No, and the management created a really reliable business, as we can see here. We have the EPS of the company in each economic downturn period, 2001, 2009, 2016, and last year, 2020. And as we can see, in each economic downturn, the company generated more earnings than in the previous economic downturn. And that is because engines are a really needed product for the industrial and the economy. About the sustainability of the business, that is a key point. The company has an investment grade credit rating, so the financial position of the company is good, and I see the company also in the next 10, 15 years with good financial performance. So the business is sustainable. Now, what is the narrative? Because it is important to understand the history and what is happening or what happened to have some insights about what is going to come for this business. The narrative is simple. No, it's an easy, understandable business. Basically, what happened is that EPA requirements pushed to higher R&D, which resulted in high barriers to entry and means superior products that displaced those of competitors. In the beginning of EPA standards, Cummins and Caterpillar were competing in the heavy-duty truck segment, but Cummins displaced Caterpillar, as also it did in the medium segment. One of the things, the key things that happened to Cummins is that since 2014, the company started to acquire distributors, because currently the company only played in the one stage of the demand supply, not only manufacturing engines, and then they said, why we do not purchase also distributors to have better access to clients? And from that, we can provide service, aftermarket sales, services to customers. That's what they did. That strengthened margins and create a new income component, more sustainable, less reliant to economic cycles. And right now I can say that closer to 20% of sales come from services provided after selling engines. And so that is a good thing that happened with the company and is still sustainable into the long term. And the other thing, as I said before, is that the significant install base of Cummins engines create a snowballing effect, supporting the development of a strong customer captivity. Here in the right side, I have some charts that I found in documents published of Columbia Business School about Cummins, and we can see here that how the company gained market share and how the company, for example, here we have the absolute research and development relative to its peers, and we can see that Cummins is the company that invests most in research and development. So it creates a competitive advantage over its peers. And it is true that the data is until 2014, but the history is still known that it doesn't change what is happening right now with the company. Here down we can see how the company gained market share, and this upward trend is explained by those factors that I said before. The high barriers to entry created by emission standards, how the company, the management took this as an opportunity to invest more and deliver to the market high quality products valued by customers. So customers purchase more engines, and then they are captive customers. That's the narrative of Cummins. No, so from that point, I can form the long-term perspectives of the company before valuing it. The company provides engines that are used to produce, to bring services. So it is important to understand the business cycle. And I believe that we are now seeing early signs of the beginning of a new business cycle, mainly in China, that should contribute to the recovery in sales. And I say that because we can see that purchasing manufacturing index right now are recovered from low levels caused by the COVID pandemic. Right now we are seeing the US yield curve steepening, heavily steepening, and those are early signs that the new business cycle is happening. That we are seeing a reflation in prices, in economy, and activity. So as this company is heavily related to business cycles, that's a good thing, and we would expect a recovery in sales. Also a positive tailwind for the companies that right now governments, as perhaps everybody knows, are stimulating heavily the economy with fiscal stimulus, and usually governments direct those fiscal stimulus to construction, to infrastructure development, to real estate, and those are end markets of Cummins. So that's a good thing. Another key point thinking into the long term is that usually we see inflation as a threat. That is true, but you have to think of engines like components that can save money to end markets by the best engines are going to be those that consume the less oil relative to the power that they can generate. And so a recovery in oil prices also increases the demand for better fuel efficient engines, as those manufactured by Cummins. So that's why we are seeing a recovery in oil prices. But the demand of the products of the company are still strong because more people need those engines that save money. And we can see also as a positive tailwind that U.S. government's environmental support policies are going to support the demand for those products that are friendly environment as the engines produced of Cummins. And now, as I told you before, the new power segment, that is more like a call option business opportunity, but it can also has the potential to bring a huge business opportunity for the company. And also, the company has a plan to 2015 to be a really environmental friendly company, that its engines are not going to pollute anything and are going to be fueled by sustainable energy sources. So those are really positive tailwinds that support a good long-term perspective for this company. And from all that analysis, I can make evaluation of the company. I don't know if until this point you have any question or any comment that you would like to do.
It's absolutely clear, your explanation. So I can understand that the company has a good leadership on the market, and all products are very high quality. And I really appreciate the fact that the company invests a lot of money in research and development, so it can make some advantage even with other peers. So, and even at the end with the business environment, the financial environment, so we can understand that engines are absolutely central. that they could be electric or classic engine, let's say, but will be absolutely central in our economy, even in the future. So it's really clear that this company has a strong position right now. It could still have a great potential and business in the future.
Yes. You said well, and that is true. That's what is happening with this company and its business and the industry environment where it operates. So basically, the valuation, I did it under two methods, both taught in the methodology of value investing that started, as you know, in Columbia Business School. And I used the discount-free cash flow valuation and the franchise return valuation. The discount-free cash flow valuation, well, everybody knows how it works. It's basically projecting the free cash flow of the company over to, 3 to 5 years, calculating a terminal value, then bringing that into the present value and subtracting the debt. And then we have the equity value of the company, and then we compared it to the market capitalization of the company to see if it has a discount. In my assumptions, when valuing the company, I projected that the company could grow sustainable until 2025 at a component average growth rate. I mean, the sales of the company closer to the 5.3%. Why? In the United States, I would not expect a growth per year more than 2% per year. But the positive tailwinds that we are seeing in China and the perspectives that markets have for China over the decade, that China is going to maintain its growth closer to 5% in nominal terms, and the new emission standards that require more friendly environment products gives me the perspective that the company and its low penetration also in the market, because it only has 15% of the market share, but it could increase even more. I believe until 20-25% is conservative. So the company as a whole can grow the 5% per year in revenues until 2025. I believe that the company averaged closer to 11-12% of EBIT margin over the last 7 years. So I believe that sustainable EBIT margin, not conservative EBIT margin, it should be closer to the 10%. From that point, I calculated free cash flow to the company. And as we saw before here, I don't know if I had the number. Well, I don't have it, but it is also, the company invested heavily in research and development, but that investment do not represent more than 5% of sales. So it's not a heavily capital intensive company. And from that point, I calculated the free cash flow to the firm. And how I discounted those cash flows. Well, right now, 10-year investment grade corporate yields are closer to the 2%. So basically multiplying that by 2, I have a WACC that was closer to a 4%. So it is low, but I also tried the other method, which is, the capital asset pricing model method, which is you have the equity risk premium, you multiply it by a beta and ask the risk-free yield. And the beta of this company is less than 1. And why is that? Because the leverage of the company is low relative to the leverage of an average company, so it's less risky, and that's why its WACC is its weighted average cost of capital is low. We are speaking about closer to 4%.
Yeah, from that point, 3.9.
Yes, exactly. So from that point, I calculated the implied per share value of the company, which I believe it is closer to the $340. Right now, the company is trading at $246. And the discount to that implied per share value is significant. We are speaking closer to 40%. So that brings me that margin of safety that we require. That perhaps if I am wrong, I have that margin of safety.
Yeah. Okay, it's clear. So the estimated price, the intrinsic value at this point is around $340.
Yes,
So,
exactly.
Okay, perfect. Time of recording. So you did this calculation when the price was 246. We are now recording on 25 of February. The price is 258. So it's a little bit more, but we still have some discount from the intrinsic value. So it could be worth to consider this as a possible investment. Yeah.
Yes. Right now, in my average cost of purchasing this stock is closer to $166. So the history of the company did not change so heavily relative to last year. So the intrinsic value of this company last year was close. At this part of the year in 2020 was still closer to the $340. So as you can see, I purchased the company at a really discount, and the market right now, 1 year after, we can see that my perspectives, my evaluation, the methodology that we apply was right, and the company and the market supports that.
Absolutely. I just saw your portfolio before our registration, our recording. I can see that this position in your portfolio at the moment is plus 50% or something like that.
Yes, and over the long term, I expect a really good returns. And for us, a return above 15% per year is really adds value and it's good. And the other method that I used was the franchise return valuation. This method is not so heavily widespread, but it also gives you about an insight about how the company can compound its earnings power over the long term relative to the value that it creates to the capital invested. So how do I apply this? I calculate the sustainable earnings of the company into the coming 5 years, right? So, with sustainable earnings, I mean EBIT, earnings before interest and taxes. So a really conservative number for the earnings before interest and taxes for Cummins in 2025 is closer to $2.5 billion. That earnings power relative to the current market cap of the company means an earnings yield closer to the 7.1%. And I expect that the company over the coming 5 years would distribute to shareholders closer to $1.9 billion in dividends and net buybacks. So relative to the current market, that means a cash return closer to the 5%. So the company is earning 7%, but is distributing 5%. So it's reinvesting almost 2% to the business. So that 2% is going to be component into the long term relative to the value that it creates. And the value that it creates is that profitability that is above over the weighted average cost of capital of the company. And basically, we divide the sustainable ROIC of the company by the WACC. That's the value creation factor, how much the company is earning relative to its cost of capital in that company. As I said before, it is closer to the 17%, the average of the ROIC of the company over the last 7 years. But I believe that a sustainable ROIC is closer to the 10%. So that brings a value creation factor of 2.6% to 2.6, 2.7 times. and that is multiplied by how much the company is reinvesting. And that brings a reinvestment return almost to 5%. So what is being reinvested in the company is going to compound at a 5% per year. Now, the organic growth of the organic growth rate, I would expect this to be closer to the economic growth, to the world economic growth over the coming 5 years, because the company sells 50% to the United States, 50% to the rest of the world. So 3.3% is sustainable, it's conservative. So the total return is at 13.6%. So this is the addition of the cash return, how much I will earn for holding the stock over the coming years, relative to how much it costs the stock price, the reinvestment return, the value creation, because the management is going to reinvest some part of those earnings in the company that are going to generate returns above the cost of capital, so that creates value, and the organic growth rate that is a more an economic factor. So I would expect that the company, the value of the company could be component in a rate of 13% per year over the long term.
That is a really good return, 13% per year in a long term.
Yes. So I have those both valuation methodologies giving me good signals about this investment opportunity. What are the risks? Well, the risk is that the economic contraction could be prolonged in time, because markets right now are expecting a recovery by 2022, 2023, but anything could happen. Perhaps the economic contraction lasts even more time. So obviously that is a risk to the valuation. A strong US dollar is also a risk for this company, because 50% of its sales comes from abroad. So a strong dollar will make it less competitive. And also a risk is that perhaps, I don't know, the US in the next government, or China and its emission standards are not as I mean, the lack of performance in the emission standard, mainly in emerging markets, do not bring that opportunity that we are seeing, and customers start to purchase perhaps less efficient engines, which I don't believe, but it's also a risk. And also a risk for the valuation is the development of some secular trends impacting the demand for trucks, for example. That those are the risks for these valuations.
Yeah, because as a normal, as the automotive industry in general, it's really depending on economic state of the how good economic goes. So when we are in expansion, so we have a good expansion economics. So the company goes really, really good, and in the other hand, if there is some recession, for sure the company is not going to perform very well.
Exactly. You will say that those are the main risks for the valuation. So basically, that is the story and the valuation of Cummins, and I'm able to discuss with you more about it, answer any question that you might have that might be of interest to your audience.
Yeah,
meet that.
I can invite everyone to leave your comment just down below. We will be happy, me and Martin, to answer to all our questions about the business and about evaluation of the company and even about the market of this company. So the automotive industry and the light truck industry in this case. So really thanks, Martin, because you have done a great job, great research. And I don't know how much effort is needed to make this kind of research and work. But as we have discussed, this kind of works even repay. I mean, at least as investing, where you are having a good return on your portfolio. And for everyone that wants to see Martin portfolio or my portfolio, you will find the link down below in the description. So thanks again, Martin, for all your job.
Domenico, thank you for the opportunity.
You are really welcome. And when you want to present us more of your study or more of your company, you are always welcome. I just remember all of you that you can find just above the link to see all of the playlist with other analysis that we have done with other company. Subscribe if you have if you haven't done yet, and please press the like button to help us with the YouTube algorithm. See you in the next video, and bye bye.
For sure. Bye bye, Domenico. Have a nice day. Thank you again.